In prior videos, we looked at fringe benefits, cafeteria plans, and the valuation of fringe benefits. In this video, we'll take a closer look at when these fringe benefits are deducted as either pre-tax or post-tax. Pre-tax deductions are deductions that are withheld from an employee's gross pay. That means that these deductions reduce the taxable income of the employee. Pre-tax deductions are voluntary deductions that the federal government decided are eligible for pre-tax withholding status. That includes certain types of insurance, retirement plans, and cafeteria plans. One common pre-tax deduction is insurance, and in the case of insurance, it's common for employers and employees to share the cost of health insurance. Your employer may pay 80% of every employee's insurance premium, and the employee pays 20%. Or sometimes the employer pays 100% of the employee's health insurance coverage and a certain percentage of the family health insurance coverage. It is up to the employer, but it's an important consideration when accepting a new position. Several companies I worked for paid 100% of the entire family health insurance premium, which is very generous. However, that's not always the case, and often the employee pays a large part of the health insurance premium. That is why it's a nice tax benefit when the premiums that the employee pays for can be deducted as pre-tax. To qualify for pre-tax status, the insurance plan must meet the following IRS requirements. Health plan must be offered through the state's small or large group market. It can be an employer's self-insured health plan or the DoD's non-appropriated fund health benefits program, a governmental plan, COBRA health coverage, or retiree health coverage. In addition, in 2010, the Affordable Care Act was passed, providing small businesses a tax credit for providing health insurance coverage when their employees are at low and moderate income levels. The Act extended coverage of children under the age of 26 to be included as an option to employees on a pre-tax basis. The payroll accountant must also be aware of the reporting requirements for employees' health insurance programs. Sometimes employers are offering additional health and disability insurance coverage that is entirely paid for by the employee. One of the largest providers of this type of insurance is Aflac. Long-term disability is excluded from taxable income under the IRS Revision Ruling 2004-55. If an employer pays for long-term disability insurance, these amounts may be excluded or included in gross pay, depending upon the election of the company. When determining the tax treatment for the supplemental health insurance, the IRS guidance provides the following. If the income derived will be estimated to be tax-free, then the costs associated will also be tax-exempt. However, supplemental health and disability plan premiums are not tax-exempt for Social Security and Medicare taxes. What about retirement plans? Retirement plans have two different types, defined benefit and defined contribution. A defined benefit plan means that the employee will receive a certain amount each period after they retire, whereas defined contribution plans differ in that the employee contribution is a set amount, usually a percentage or a fixed amount per pay period. In a defined contribution plan, the amount received by the employee after they retire varies. Some examples are 401k or 403b, a SEP, an ESOP, simple 401k, IRA, and simple IRA. It's up to the employer to decide if they will offer a retirement plan and which type is best suited for their firm. The contribution limits for 401ks are $22,500 for 2023, plus a catch-up contribution of $7,500 for people over 50. For 2024, the contribution increased to $23,000, whereas the catch-up contribution remains the same. Now that we know what employer costs can be deducted as pre-tax deductions, we can move on to post-tax deductions. Post-tax deductions are deducted from the employee's pay after federal, state, and local income taxes and FICA taxes have been deducted. These post-tax deductions can be both voluntary deductions and court-mandated deductions. In other words, sometimes these deductions are up to you to pick, whereas other times a court will do so for you. Voluntary post-tax deductions are, for example, donations, union dues, supplemental insurance, whereas court-mandated deductions include garnishments, tax liens, and child support. The voluntary post-tax deductions are pretty straightforward, right? These are deductions that you signed up for with your employer. So let's talk next about court-mandated deductions. One of the basic rules is that court-mandated deductions cannot take away the employee's entire paycheck. The Consumer Protection Act has specific guidelines about how much of an employee's pay may be deducted for each class of garnishments. Garnishments may not be more than 25% of the employee's disposable earnings, or the amount by which an employee's disposable earnings are greater than 30 times the federal minimum wage, $217.50. In case you're wondering, disposable income is calculated by taking the gross wages of the employee and deducting all mandatory withholdings. One common court-mandated deduction is child support payments. When there are court-mandated child support payments that must be withheld from an employee's paycheck, the deduction may be up to 50% of disposable income if the employee is supporting more than one spouse or child, or 60% if the employee is not supporting another child or spouse. There's an additional 5% for any child support that is more than 12 weeks in arrears, meaning past due. There are other court-mandated deductions, such as liens and other garnishments. The maximum amount that can be withheld from an employee's paycheck depends on the type of debt the employee has. U.S. government debts and student loans have the same maximum amount to be withheld from the employee's paycheck. 15% of the earnings in excess of federal minimum wage weekly earnings. Consumer credit loans have a limit of 25% of the earnings in excess of federal minimum wage weekly earnings. For personal bankruptcy, the amount to be withheld from the employee's paycheck is the lower of 25%, or 30 times the amount of weekly income in excess of federal minimum wages. For tax levies, see IRS Publication 1494, which tells you how much of an employee's paycheck is exempt from levies based on the number of dependents the employee has.